Imagine a bank, not just any bank, a Swiss bank, carved from granite, solid as the Alps themselves. An institution that has weathered world wars, economic depressions, and the rise and fall of empires for 167 years. It is the very symbol of permanence, of safety. Now, imagine it vanishing. Not in a riot, not with panicked crowds hammering on locked doors, but with the silent tap of smartphone screens, bleeding billions of dollars in a matter of hours. What does a bank collapse truly look like? Is it the black and white photo of a mob in 1929? Or is it the 2023 digital wildfire that consumed a giant over a single weekend? The truth is, bank failures are not random accidents. They are not bolts of lightning from a clear sky. They follow a blueprint, a hidden pattern of excessive risk, collective delusion, and systemic fragility that repeats over and over. We are taught to see these events as isolated crises: the Great Depression, the 2008 meltdown of Lehman Brothers, the shocking 2023 implosion of Credit Suisse. Today, we are not just looking at the wreckage. We are dissecting the blueprint. We will uncover the bloody, unlearned lesson from three seismic events: the 1929 crash that started it all, the 2008 collapse of Lehman Brothers that froze the world, and the shocking 2023 implosion of Credit Suisse. Because only by understanding this blueprint can we understand the danger we are still in. The year is 1929, the roaring 20s, a decade of exuberant, jazz-fueled optimism. Stock prices only went up. Everyone, from Wall Street bankers to shoeshine boys, was a market genius. This was the new era of permanent prosperity. The stock market crash of October 1929 was the gunshot that shattered the illusion. But the crash itself did not cause the Great Depression. It was only the catalyst. The real disease, the one that would hollow out the global economy for a decade, was the collapse of the banks. In the 1920s, there was no safety net, no FDIC. Your money in the bank was only as safe as the bank itself. And banks had been speculating wildly, using their depositors' money to gamble on the soaring stock market. When the market vaporized, so did the bank's capital, and the whispers began. A bank run is not a financial event, it is a psychological one. It's the terrifying realization that the paper promise in your hand might be worthless. It starts with one person running, then 10, then 100, a contagion of fear. Look at the Bank of United States, a grand name for a private institution. In December 1930, it was the largest bank failure in American history at that time. It didn't just serve the wealthy, it held the life savings of 400,000 ordinary people, immigrants, small business owners, workers. When it failed, they weren't just inconvenienced, they were ruined. Life savings, accumulated over decades, vanished overnight. It was this event, this betrayal, that turned a recession into a catastrophic depression. Over the next few years, more than 9,000 American banks would fail. The floor of the financial world had disappeared. What was the bloody lesson from 1929? That confidence is fragile, that a banking system without safeguards is a house of cards in a hurricane. The response was monumental. The Glass-Steagall Act, building a wall between conservative retail banking and speculative investment banking, and the creation of the FDIC, the Federal Deposit Insurance Corporation, a government promise this will never happen to your savings again. It was a firewall built to last forever. It lasted about 60 years. Fast forward to the 2000s. The firewall was gone. Glass-Steagall had been repealed, paving the way for a new generation of financial supermarkets that combined every form of risk under one roof. The language of banking changed. It was no longer about simple loans and deposits. It was about financial engineering. We created a new alphabet of destruction, MBS, or mortgage-backed securities, and CDOs, collateralized debt obligations. It was financial alchemy. Banks took thousands of risky subprime mortgages, loans given to people with poor credit, and bundled them together. They then sliced this bundle into new complex bonds. Magically, rating agencies stamped these toxic bundles with AAA ratings, the safest investment grade possible. It was, quite simply, a lie, a way to sell garbage as gold. And no one bought more of it than Lehman Brothers. Lehman was the fourth largest investment bank in America, a 158-year-old institution that had survived the Civil War, the Great Depression, and multiple world wars. It was considered invincible. But by 2008, it was hopelessly exposed. It was leveraged 30 to 1, meaning for every dollar of its own capital, it had borrowed 30. It was a skyscraper balanced on a toothpick. When the housing market finally cracked, the subprime mortgages defaulted. The AAA bonds were revealed to be worthless. The toothpick snapped. On September 15, 2008, after a frantic weekend of failed bailout talks, the U.S. government made a fateful decision. They let Lehman fail. The effect was instantaneous. It was the financial equivalent of a nuclear bomb. The global credit system, the plumbing that allows money to flow between banks, businesses, and countries, froze solid. Banks stopped lending to anyone, even to each other. They had no idea who else was holding the same toxic garbage that killed Lehman. This time, the lesson was different. It wasn't just about confidence. It was about interconnectivity. We had built a system so complex and intertwined that the failure of one firm could trigger a global cascade. The term "too big to fail" entered our vocabulary. We learned that the giants of finance were all holding hands, and they could all fall down together. The government, which let Lehman die, was forced to bail out AIG, Citigroup, and the rest. The blueprint had evolved. The risk was no longer contained. It was systemic.
We are pausing here for a moment. The connections between 1929 and 2008 are clear, but the story is not over. What happened in 2023 proves this blueprint is still active. If you are finding this analysis valuable and want to understand the hidden patterns of history that affect your money and your world, take a second to subscribe to our channel. We dissect these critical events to show you what others miss. Now, back to the timeline. You would think we learned. We created new regulations. We stress-tested the big banks. We swore we had made the system safer. Then came 2023 and the collapse of Credit Suisse. This was different. Lehman was a high-risk gambler. The 1929 banks were reckless speculators. Credit Suisse was old money, a 167-year-old pillar of Swiss banking, the global symbol of stability and secrecy. Its collapse wasn't a sudden heart attack like Lehman's. It was a death by 1,000 cuts, a slow, agonizing decay of the most important asset a bank has, its reputation. For years, the headlines dripped with poison. A spying scandal targeting its own executives, a money laundering conviction related to Bulgarian cocaine traffickers, billions lost in the collapse of the Archegos hedge fund, billions more lost in the Greensill Capital scandal. It was a staggering display of incompetence and rotten internal culture. Each scandal was a crack in the granite facade. The bank was already bleeding. Wealthy clients were pulling their money out, slowly but surely. By early 2023, the bank was desperately trying to reassure the world it was stable. And then the final push. In the midst of a global banking panic, sparked by the failure of Silicon Valley Bank in the US, a journalist asked Credit Suisse's largest shareholder, the Saudi National Bank, if they would invest more money. The answer was a simple no. That was it. That single word, spoken on camera, was the death sentence. It confirmed every hidden fear. The digital bank run began. It wasn't a mob with pitchforks. It was wealth managers, corporations, and billionaires tapping on their phones. In a single day, over 10 billion francs vanished. The bank was hemorrhaging faster than any bailout could save it. It was so toxic that it couldn't be allowed to fail like Lehman. The panic would be too great. Over a single frantic weekend, the Swiss government abandoned all pretense of free market rules. They forced Credit Suisse's healthy rival, UBS, to buy the dying giant in a shotgun wedding, wiping out shareholders and certain bondholders. The lesson of 2023? That in the digital age, reputation is the only real asset, and that speed has changed the game. A bank run that took weeks in 1929 now takes hours. We learned that some banks are not too big to fail. They are too big to liquidate. The only solution was to force a contaminated giant onto a healthy one, creating an even larger, more systemic megabank. So what is the blueprint? What is the unlearned lesson? Look at the three events together: 1929, 2008, 2023. The details change, the assets change, from speculative stocks to complex CDOs to a ruined reputation. But the core blueprint remains identical. Step 1, excessive leverage, gambling with other people's money. Step 2, a culture of ignored risks, chasing short-term profits while dismissing the red flags. Step 3, a sudden crisis of confidence, a trigger, be it a market crash, a subprime default, or a single comment that exposes the rot. Step 4, the panic, a contagion of fear, now moving at the speed of light. The ultimate bloody lesson is this: the system itself is inherently fragile. The safeguards we build, FDIC, Glass-Steagall, stress tests, are always one step behind human ingenuity for finding new ways to create risk. The next collapse won't look like Credit Suisse, just as Credit Suisse didn't look like Lehman, but it will follow the same blueprint. History is not a bedtime story. It is a warning, and it is warning us, louder than ever, that the illusion of permanence is just that, an illusion. But this blueprint isn't complete.
History is still being written. What patterns do you see in the financial world today? And which historical collapse do you think holds the most important lesson?